Today we continue the discussion around reps and warranties insurance, and I take it from the seller's perspective. I've produced a few videos on the subject of reps and warranties insurance, a form of transactional liability insurance commonly used in the world of mergers and acquisitions, and I thought an example of how this is deployed may be helpful, especially for business owners who are or may be approaching the sale of their company in the near future. In this example, the client, let's call him George, is a second-generation owner of a successful food products distribution business. George is in his early 60s and he's being approached by a mid-market private equity firm looking to expand their holdings in the food distribution vertical. The initial discussions between George and the PE firm are encouraging. The potential buyout numbers actually exceed George's expectations, but he knows that negotiations and discussions will still need to take place in order to get to that target buyout figure. George feels good that after the years of hard work, long hours, and the personal capital he invested in the business were worth it. He is now going to reap significant benefits from all of that work and investment. He is now going to reap significant benefits from all that hard work and personal investment. The PE firm conducts an abbreviated diligence on George's company, which was a bit of a relief for George. Not that he has anything to hide, but it just concerned him that a sophisticated buyer could drag out negotiations over a long period of time and he'd end up with less than he initially expected. But that abbreviated diligence did result in a long reps and warranties schedule. A reps and warranties schedule is a set of factual statements about the company's conditions that George will be making and guaranteeing to the buyer. If those statements or facts are breached after the sale, George could be sued for the financial damages the buyer suffers as a result of incorrect information made in the schedule. In addition, the private equity firm wants George to deposit 10% of the sales proceeds into an escrow account for 2 years to help guarantee the accuracy of that schedule. George has no problem committing to these facts contained within the reps and warranties section of the sales agreement, but it does worry him. He knows his company and its finances inside and out. He was confident that all of the statements he made were true and honest. But in the back of his mind, he worries that a big private equity firm with a lot of lawyers may try and prove some of his statements as false or untrue down the road, and he ends up in litigation. The last thing George wants to do is litigate with a powerful financial institution and possibly have to return a portion of the sale proceeds back to the buyer when he didn't do anything wrong. This nagging feeling probably plagues every private seller, and the thought of leaving 10% of the proceeds on the table at the day of the closing is of course worrisome. You sell your company and you want to walk away with the proceeds and invest them for the benefit of you and your family. After all, you just sold your biggest asset and are headed towards retirement. The more time all of that asset is earning interest, the better. The good news is that there is a ready-made solution for George and other business owners selling their companies in the form of reps and warranties insurance, or R&W for short. With an R&W policy, George is able to lay off most of the potential risks contained in the deal to an insurance company instead of risking his own money left in escrow. Yes, there is a premium and other fees to pay for the insurance, but financially, the math works out in George's favor, and in this situation, he gladly exchanges his premium payment for certainty at the closing table. In this video, I give a better understanding of how the premium and retention works in a reps and warranties policy. So, at the end of the day, the transaction moves forward after the R&W insurance is placed. George walks away with the full proceeds, less the premium for the insurance, and post-closing liabilities are minimized. The private equity firm got the company they wanted at the price they wanted to pay for it, and everyone was happy. Okay, I get it. That's a bit of an oversimplified example of how reps and warranties insurance works, but it does give an insight into what's on the mind of the seller when they're about to make the biggest financial and actually emotional transition of their life. In my next video, I'm going to discuss a new form of transactional liability insurance designed specifically for the small business market. Stay tuned for that, but if you have other questions about reps and warranty insurance, why not give me a call or drop me an email? My contact info is coming up, or you can book a call on my schedule in the link in the description box below. Thanks.